So let's have a quick check back at what happened on the final session of last week. Pretty important sort of set of US economic data releases, and we had some interesting moves off the back of it, including, of course, just can't keep this thing down. This is the S&P cracks new all-time highs again on Friday. Let me just adjust a couple of these lines. So this is Friday's candle, top right of this S&P chart, and we rose and took out the mid-June high. So new highs for the last sort of month, new all-time highs, of course, as again we kind of make this push towards 2,500. Let's just say if we go back on a weekly chart, then this has been a meteoric rise, would be an understatement. If you're going back to the beginning points of 2016, which was the last time we had a little bit of an episode of panic, let's just say. First couple of weeks of 2016 saw some sharp downside off the back of commodity prices collapsing, off the back of China risk. Since then, we've been pretty much straight lining it to the upside. Couple of wobbles, June 2016, another one sort of October into November 2016, around the US election, of course, and then, but it's been so steep, a lot of this push to the upside, and again, this trend is ongoing, for sure. You can't keep this thing down. So why did it rise? Because actually, I mean, the irony of the push to the upside is the fact that actually on Friday we had some US data. On the one hand, was a hell of a lot worse than expected when you're looking at the retail sales data. But before we look at retail sales, let's look at the data which arguably was slightly more important, which led to the move to the upside in equities, and of course moves across the board. So if I just transition my screenshot and we check out the US annualized CPI chart. So what we had was a fifth month in a row of a decline in the headline inflation print. And this was a surprise. We had, well, no, it wasn't a surprise in that what was expected was 1.8%. So we were expecting a drop again from the May reading of 1.9, but it dropped more sharply than expected, 1.6%. And as you can see on this chart, that puts us back at levels we haven't seen since October last year. Obviously in 2017, the big story, or let's just say from December 2016, you would say the Fed have finally properly got their inflation hiking cycle underway, and it was looking like they had all the ammunition and justification they needed to get going on this cycle, because inflation started to stretch its legs up through 2%, up through 2.5%. But obviously over the last 5 months this has dipped, and actually now dipped quite sharply, and we're down to 1.6%. This is inflation going the wrong way for the Fed's hiking ambitions. However, this is on the headline. If I just transition back and show you a chart, one thing you've got to bear in mind here as I get the chart of oil and have a look on a weekly time period. Let me just get rid of these pivot levels so that we can tidy this up a little bit. Let me just get rid of all these lines. Sorry, Ant. I'm just going to delete everything here, start again. So this is the price of crude oil, and obviously this is an important part of the inflation basket, energy costs. So you've always got to be thinking, right, well, what's the energy contribution to the inflation basket? And so you've got to look at the price of oil in the month of June, and of course this is where we dipped, and middle of June tested the $42 handle at a price point we hadn't seen since November last year. So in June, the average price point was probably south of $45. Well, what was the price in June 2016? Here you can see actually the price was between 45 and 50. So actually oil is contributing a negative element to the inflation basket. Okay, that's on the headline. So that explains some of this drop. But if we go back and look at the core inflation print from the US, so that's taking oil out. It's also taking food out of the equation as well. But if we have a look at core inflation, then this actually didn't disappoint in that we had expected 1.7%, and it came in line at 1.7. The month-on-month reading did, however, come in below expectation. But as you can see, 1.7% is just confirming what happened in May, which was a sharp drop to levels we haven't seen since actually 2015. So again, you look at this chart and you're thinking, well, what inflation pressure? This is a problem for the Fed because they're gearing up towards bringing in a reduction in their balance sheet as part of this exit strategy. They've hiked rates 3 times, December, March and June. Now the thought process is in September they're going to take a breather on the rate hiking and instead begin, or at least announce that they're going to begin, a reduction in their balance sheet. This will be done by the or tapering reinvestment of monies coming in from redemption payments. So when a bond, obviously the Fed's balance sheet is packed full of government bonds and other stuff, mortgage-backed securities and the like, but when these fixed income assets reach maturity, there's a redemption payment. So let's say a government bond, well, the US government pay the bondholder at redemption, and that's the Fed, of course. So the Fed take in this cash, and then at the moment they're reinvesting it fully to maintain the balance sheet at a constant level. In September, we're expecting the Fed to say, well, all right, we're going to take in this cash, but we're no longer going to reinvest it all. Some of that, and we're not quite sure how much yet, maybe 20% of it, they're going to say, right, we won't reinvest that, and we'll scrap that, we'll scratch that, we'll burn it, and this will reduce the money supply marginally as we go through time. Then they're thought to get back on the rate hiking in December for a 3rd rate hike in 2017. This was the plan, but of course this inflation data continues to maybe put that plan at jeopardy. And when you're looking at Fed hike expectations, well, current probabilities for a hike in September are now down to just 10% chance. But that was never going to be a meeting that we were necessarily thinking the Fed were going to make a move. It was more the December meeting, but actually chances of a rate hike in December now have dropped below 50%, and they're down at 45% as of this inflation data on Friday. So let's just quickly flick back and have a look at how this had an impact. Obviously, for the S&P, you might say this is obviously good news in that less rate hikes from the Fed. The cost of borrowing isn't going to go up as fast. Tightening is not going to be pushed through quite as rapidly. And this is good news in the short term. So US equities stride to the upside. And we had actually 3 punchy days to finish off last week. Wednesday, Thursday, Friday. 3 large steps to the upside, breaking the June high, new all-time high set. Okay, so equities loved it. If we have a look at some of these other asset classes, what happened to bonds? Let me just bring in US T-notes here. Typically very dovish movement across the spectrum as the US T-notes rallied strongly to the upside initially. So this is prices moving up, that's yields dropping off the back of lower inflation than expected, and perhaps also off the back of the fact that we might not see the Fed hike again in 2017. You saw this then snap back actually and reverse almost all of it. In fact, pretty much did reverse all of it. And we've kind of been sideways ever since. But if you have a look on a daily chart, that spike higher, we'd already bounced quite sharply off the key low. And let me just draw this line because the May low is very important for T-notes at 124.23. We almost got there on the 6th and 7th of July, but we're kind of on the way back now. And so you would probably expect this market to continue to favor the upside, I would say, as we're going through the first part of this week. So certainly, or initially at least, bond prices higher as yields dropped off the back of this inflation data. Gold, check out gold, nice punchy move to the upside, all classic kind of dovish reactions here. Gold only reversed half of that move and now has been drifting, and check 1232.70, that was Friday's high, so that's an important price point as we track through the first part of this week. Again, gold is rebounding, similar to bonds. Gold is trying to rebound, sharp downside that we've seen through the month of June. For gold, of course, again, let me just tidy up this chart. So yeah, let me just delete everything. We could do with a good tidy up of these technicals. So the May low for gold did get broken, unlike T-notes, but only briefly. As you can see, a bit of a hammer here posted, and you know, big stride higher on Friday, and gold will be looking to kind of, you know, keep its head above 12, the kind of 1230 area, and try and track back up. I'd say 1240 is key. This was the low points we encountered. Key support here around about the mid to latter part of June, before then the big blowout move to the downside on the 3rd of July. So 1240 on the way back up will be an important price point. So again, favouring perhaps the upside, I'd say, first part of this week for gold. What about the dollar then? Well, certainly and initially, if I just do that, the dollar weakened across the board. So you had euro dollar driving to the upside, and we eventually just about took out the high point that we had from earlier in the week. Obviously then it got a bit messy in the consolidation. We then just overnight just ticked up through that Friday high, testing 115.10, but as you can see at the moment, definitely favouring the downside here. We've broken the pivot level, and just check where we're testing now. This was the key consolidation point after the spike higher on Friday. So 114.74 was almost like the double bottom of this consolidation pattern after that inflation driven spike to the upside. So the dollar weakened, gold went up, T-notes went up, equities went up. And when you're looking at pairs like euro dollar and K, basically everything went up off the back of the US inflation data. But bear in mind oil, all right, that kind of just waters down this inflation story. But you can't say that when you're looking at core inflation, which, as I said, is the lowest we've had for a couple of years. So all eyes on this inflation situation as we track through the rest of the summer. It wasn't just inflation though. Check out the retail sales data that was announced for the month of June, and this was also incredibly bad. I have to say, this is one of the worst retail sales reports I've seen for a long time. Just worse than expected across the whole spectrum. On the headline, minus 0.2%. When you take out autos, it was again minus 0.2%. When you're looking at I've forgotten the name of it now. Wow, there's another component of retail sales that's looking more about kind of GDP, which is also like worse than expected. It was just bad right the way across the spectrum. And as you can see, second negative print in a row on the headline here. If I just make that chart a bit bigger, minus 0.2, that follows up the May reading of minus 0.1. Of course, we had a negative print back in February as well. So this year, 6 months, 3 of them negative. If you look at this on a 5-year kind of time frame, retail sales is always quite choppy as a data point. It's always quite volatile, but certainly 3 negative readings here in the last 6 months isn't a positive, obviously. But what I'd say, this is perhaps maybe a broader story. I was reading a great article in the FT this morning about, you know, what's the next big short in the US. Obviously, we had a big short on the housing market back in 2007 and 8 and the financial crisis. And if you're talking to the big kind of top-level hedge funds at the moment, the big short they're getting very excited about is actually the retail space. And this is kind of bricks and mortar retail, and all part of this secular shift, of course, away from bricks and mortar onto e-commerce, online retail. Obviously, they call this the Amazon effect. What they're expecting is this is going to accelerate dramatically as we hit the second half of 2017. There was a phenomenal stat I read, just to give you a sense for just how much retail space in square meters there is in the United States. So measuring it per capita, so there's obviously over 300 million people in the US, but per head, there's 24 square meters of retail space in the United States. 24 square meters per head. Now that number in itself might not mean anything to you. That, you know, is that a lot? Is that not a lot? Well, the second, well, they're top of the list in terms of the most retail space per head, 24 square meters per person. Second on the list is actually Australia, and Australia come in second, and they've just got 11 square meters per head, not 24. And when you're looking at Europe, most of us and most of you lot listening to this are from Europe, perhaps, or live obviously in the UK. Or when you're looking at Europe, the average for Europe is just 2 to 5 square meters per head. So the US are at 24, which just puts it into perspective and just, I guess, gives you a sense for why these hedge funds are circling like vultures. You've had like 9,000 redundancies in the retail sector in the US this year per month. 9,000 jobs per month lost. And when you're looking at JP Morgan, they reckon 90 million square meters of retail space is going to get closed down this year. Credit Suisse, they think 147 million square meters. So people are starting to get very bearish on the bricks and mortar, and obviously Amazon are a part of that. But why am I saying this? Because what does that mean for actually the amount of money that gets spent? And it is a problem, because the stats show that if you go to a shop, then you tend to buy stuff you don't actually want, or stuff you didn't intend to buy, you didn't set out to buy. You know, the amount of stuff that slips into the trolley, I don't know about you lot, when I'm going around the supermarket, the amount of crap that gets into the trolley by my kids subtly sliding in there some kind of chocolate related product, and you get to the till and you buy a load of stuff that you actually didn't intend to buy. But the stats are that the amount of money spent online is actually about 0.85 cents to the dollar. So there's about a 15% reduction in spending online than there is in store, purely because when you're online, you tend to buy precisely what you want to buy, rather than ending up buying other stuff that you didn't intend to. So this actually is a negative thing for retail sales overall. Maybe, I don't know, it's too early to say, but maybe we're starting to see this creep into these headline retail figures. But it's definitely a story for the second half of 2017. It's this US bricks and mortar retail space, and just how sharply does this deterioration accelerate. So something to keep your eye on. Okay, so that's what happened on Friday. Let's check up on what's been going on overnight. So big data out of China. GDP figures for Q2. So China first out the gate for Q2 GDP readings being announced, and actually it's good news. So 6.9%. We had expected 6.8%, so slightly better than expected. And as you can see here, matching the print that we got for Q1. So we've had two back-to-back readings this year that are better than anything we saw last year. So in 2016 we had 3 quarters at 6.7 and then a slight blip up to 6.8 in the final quarter. So this is a good thing, better than expected, of course. Alongside these GDP readings, we had further insight into June specifically, and this was the industrial production data for China for the month of June, which, as you can see on the chart, was very strong, better than expected, matching the best print of the year that you can see came back in March here. Also, if we flick back and have a look at retail sales, this also came in better than expected. And as you can see here, best reading in 12 months. If you go back on the 5-year chart, best reading since the end of 2015 for retail sales. Obviously, we're kind of in a downward trend here, but it's flattened off, you would say, over the last 18 months, and maybe even suggesting signs we might tick higher and reverse this trend, but we'll obviously have to see. But look, strong data out of China, okay, both on the GDP front, the industrial production front, and the retail sales front. However, equities in China opened sharply lower. They did bounce after this data, but they opened lower, and that's off the back of a couple of things. Just a story circulating in the press surrounding a former Communist Party chief who's under investigation for violating party regulations. That's one kind of story that's grabbing some headlines. And then the other one, we had the People's Bank of China had a conference over the weekend, and They have become more prudent around the plans for the future in terms of financial regulation. So we might well get financial regulation becoming more coordinated. You might well see government aims to control financial risks. However, they're not going to want to sacrifice growth. So, yes, control financial risks, but not overburden or over-tighten conditions in the sector to damage growth. So that's kind of just scared people a little bit, but then the data came in and stocks rebounded. But if I have a look at the DAX, for example, we've definitely seen a move lower. I was saying on Friday, obviously stocks all-time highs in the US, preferring to ignore the retail sales data and just concentrate on the worse than expected inflation and translate that into less hikes and equities power on. But you can see this morning the DAX opened nice and strong. Opened, gapped higher, tested that high point from last week, but now we're going south. We've just broken the pivot and heading lower. So actually in China, it's more like, rather than looking at the data, it's looking at these stories about the central bank and the regulatory situation, and then this bit of a scandal blowing up about this Communist Party or former Communist Party chief. So it's a little bit hard to judge sentiment, I would say, this morning, because it's kind of mixed. You've got good news and then you've got bad news, and certainly at the moment the DAX is preferring to track back and give back some of those gains that we had on Friday. So a little tricky to judge sentiment, I would say. But when I go back to a 30-minute chart, actually I'm not showing you my charts, am I? Sorry, here was the DAX. Apologies. Here was the DAX just breaking the pivot and tracking back lower. If you look at the S&P, I'm going to go to a 30-minute. And you can see certainly less appetite for downward movement here on US stocks, it would seem. Just happy to chug sideways at the moment. But given what Europe's doing, we should maybe expect the S&P to kind of test the lows here shortly. Let's see. But pretty quiet, though, you would say, on the equity side of things in the US. Okay, so that's got you up to speed on news flow that's happened overnight. Let's perhaps just look at the week ahead then. And let me show you what's on the calendar by way of news flow. Let me bring in Monday here. So we've had this Chinese data that I've already mentioned. Actually, let's just look at the economic data for today, because we have got some inflation numbers out of Europe, but that's not until 10 a.m. okay. But also this is final readings. That's what this F means in brackets here. CPI F June year on year. That's the final June CPI reading. We've already had preliminary data on this, so this makes this less important. It's not expected to change from what was reported a week or so back when we got the first preliminary reading. So we're expecting the headline to stay at 1.3%. Okay, month on month, we'll see. Last time out it was minus 0.1%. And then on the core, we're expecting they've got a misprint here on this. So CPI core year on year is expected to actually rise from the previously reported 0.9 up to 1.1. This afternoon, the only thing of any interest is the New York Empire State Manufacturing number, and that's at 130. Okay, there's no monetary policy speakers this week from the Fed. That's because they're in their blackout window ahead of next week's FOMC meeting. There's no ECB speakers either on Monday, Tuesday or Wednesday. That's because we've got the ECB press conference on Thursday. There's no Bank of England speakers either this week. So actually, until we get to Thursday lunchtime, we've got zero input on the monetary policy side by way of comments. But obviously, as we hit Thursday, let me just show you the rest of the week in terms of the calendar, though, before we talk about Thursday and the ECB. Tomorrow's probably the busiest day for data. The Aussie Central Bank meeting minutes, Tuesdays. That's not a meeting, that's minutes from their previous meeting. We've got core inflation data out of the UK, so this will be important. Definitely very important. As I keep saying to everyone, inflation's the key measure for 2017. And what are the Bank of England going to do? Because we've been talking about the Bank of England You know, obviously we've got Brexit risk, and that's something else that's happening this week that's not on this calendar. It's Brexit negotiation week. So the idea is every month the negotiators get together for a week and try and thrash out progress. So this is happening beginning today. David Davis versus Barnier squaring up, and the usual stuff's on the agenda. Stuff that was on the agenda last time and is still on the agenda, and we don't seem to have too much progress. We need it. You know, the clock is ticking, as Barnier reminded us last week. So on the agenda we'll be talking about EU citizens' rights in the UK, and obviously vice versa, UK citizens' rights in the EU. Then it's the Brexit bill, or the exit bill, and Theresa May, for the first time last week, actually admitted that we will be paying some money, so maybe that is some progress. And then it's about the hard borders, the Irish one in particular. So this is on the agenda. We kind of need progress this week, but keep your eye out for headlines. Of course, if you're trading things like the value of sterling, then these headlines are potentially important, of course. But thinking about the Bank of England, if I just go to this graphic here, because what do the Bank of England do? Because inflation's on the up, which means they kind of want to hike, but then we got economic uncertainty around Brexit, so they kind of want to remain accommodative. Here's the stance. Obviously, a couple of weeks ago, we saw these lot turn notably hawkish. And this is why, and we'll look at the chart of cable in a minute, but we're trading at 131 right now, the highest we've been for a long time. This is because of these lot and because of the inflation data driving higher. UK inflation is very important. This is the setup at the moment. Those on the committee that maybe later this year we should be hiking, and you kind of got 4 people in this camp, or at least 3, let's say. Carney, John Cunliffe, and we've got Savannah down here. These 3 are, we should probably look to hike this year. Haldane's the key kind of pivot one here, because you've got 2 Uber hawks, Ian and Michael. They want to hike now. And then you got Haldane, who's kind of just not quite sure. Does he want to go now and pull the trigger, or are we better off waiting until towards the end of the year? So he's critical. Then you got 2 doves, Broadbent and Vilnier here, who are that now is not the time. All right, so this is the shape of the situation for currently the 8 members of the MPC. All right, so the inflation print on Tuesday, very important. Definitely the most important event for the week for the UK. We got German ZEW tomorrow morning, which is important as well. Carney speaking. So actually I said no Bank of England speakers. That's a complete lie. Carney is speaking, which is critical after the inflation data that gets announced. Okay, so that's a big moment. Most important day of the week for the UK. Outside of any developments in Brexit, of course. We've got the US earnings season carrying on, of course, after last week we had the US banks reporting. So we got Netflix today. Tomorrow we got Goldman's, Bank of America. Then we got the tech stocks coming in with IBM, Johnson & Johnson healthcare stock as well. Wednesday, hardly any data well, there isn't any data apart from the Department of Energy oil numbers and Morgan Stanley. So dead day for data Wednesday. Thursday, we've got Japanese interest rate decision, German PPI, UK retail sales. Not too much on the US side by way of data other than Microsoft and eBay earnings. Friday, virtually nothing. Really bad day for data. General Electric on the earnings. So Wednesday and Friday looking very dead by way of scheduled data. Tuesday's looking the most interesting. Today's very quiet apart from this inflation number out of Europe. Empire State Manufacturing at 130. Just thinking about Thursday, actually what wasn't on that note there was the fact that we've got ECB Thursday. So this is important, obviously. So this will be one of the key events of the week. And this is a matrix looking at the bullish, and therefore you should have dovish on here as well. Bullish and dovish, bearish and hawkish. So there's various arguments on both sides of the camp. So for example, on the monetary policy stance, The doves are saying, well, there's been little change to monetary stance over the last few weeks, so we're expecting things to stay unchanged. The bears, or indeed the hawks, are saying, well, we've had a cyclical upswing, and they're arguing in favour of some withdrawal of monetary accommodation. I think the main theme is that we're expecting September to be the key meeting, not this one. So we're expecting the meeting after this one, so the meeting in 6 weeks' time, to be the critical one, where if Draghi gets his way, and Draghi's definitely turned very confident and very confident and hawkish, and if Draghi gets his way, then we will see the announcement of further tapering to QE at the September meeting. So it's actually not so much about this meeting. What we want to see on Thursday is any little hints to see if Draghi's getting his way. Is Draghi bringing the rest of the committee around to his way of thinking? Is Draghi going to just pave the way for an important announcement come September? Okay, so we'll talk more about this on Thursday. Okay, but that's a key part of this week. So, just back to the charts then, just to wrap up. You know, as I said, a little bit tricky to gauge sentiment this morning. European equities have had a little slide. We've had a bit of dollar strength. And let me just show you cable, actually, because that's important, because on Friday we broke the high of the year, broke the 130.59 handle. That was the 18th of May high. This was after Theresa May called an election and drove this thing up above 128. Well, we tested 131 this morning. If I just zoom in, we've been kind of tracking back. So as you've seen in the euro dollar, but less aggressively here, as you've seen in euro dollar, the dollar has been trying to retrace some of that Friday weakness. Okay, so the dollar's trying to strengthen. Equities aren't quite sure what to do. In Europe, we've had a little bit of weakness, but in the US, things are very flat. On the oil front, we're just kind of tracking up around the top end of last week's ranges, up around the top, well, just shy of $47. If I draw a line in, we have broken that high point that we had on Friday. So oil's trying to push higher despite a bit of dollar strength. So a little bit mixed. So I just tread carefully as we get the first part of this week underway. You know, don't get too aggressive with any movement. I think traders are just feeling their way into this week quite cautiously, and news flow is quite light as well, unless we get any Brexit stuff happening. It's really tomorrow that the news is really going to start to pick up. All right, so next data is in 50 minutes, and that's the final readings for June inflation in Europe. Okay. Otherwise, enjoy the week. Best of luck. Thanks a lot.